Everyone, welcome back and welcome to the last presentation of the 2021 TraderLion Stock Trading Conference. We're really excited to have Charles Harris here, who is a portfolio manager over at O'Neill Capital Management, a really experienced investor and trader, and he'll be talking about buying pullbacks. So Charles, first of all, thanks so much for agreeing to be a speaker. We're really excited for this presentation, and I'm sure you're going to give a whole bunch of golden nuggets for us all today.
I appreciate it, Richard. Thanks for the intro. And congratulations on an amazing workshop. I've had the opportunity to watch a number of the speakers over these past 2 days. And I've just been so impressed by the expertise of the speakers and the breadth of information and just the many different perspectives that all the speakers have. And I think it proves that there's more than one way to be successful in the market. And that's really where this presentation kind of comes out of, is that I'm known as the guy at O'Neill that buys on pullbacks. And that doesn't happen too often amongst the portfolio managers. So really, I think it's important to trade in line with your personality and play to your own strengths, because if you're trying to be someone you're not, chances are the results are not going to turn out too well. And I've taught dozens of workshops to thousands of investors for IBD over the past 2 decades. And by and large, most of the attendees want to trade just like Bill. They want to just be like Bill O'Neill. But the truth is that Bill O'Neill was a very special individual, and he had his own strengths and an incredible stock picking acumen, huge risk tolerance, very comfortable with large positions, and he just had an amazing intuition and decades and decades of experience. So not everybody has that, and you don't have to be just like Bill O'Neill to make a ton of money in the market. So I think that is, within our overall framework of CAN SLIM and kind of an O'Neill methodology, you can kind of impress and put your own personality into that and play to your own strengths. As you mentioned, I'm a PM at O'Neill Global Advisors. I've been with the firm since 1995, and I've been trading as a PM since the year 2000, which is when Bill brought me downstairs. And it was, I got to know Bill quite well. I've worked closely with him for many, many years, and we actually shared an office together back in those early days. So I really had the privilege from learning from a true master. And one thing, though, I never learned from Bill is how to buy on pullbacks. To be honest with you, he never really endorsed it. He never really understood it. But he did say to me once that if what you're doing is working for you, don't change it. So I've always been comfortable buying kind of in a contrary way and buying when people want to sell. And so that's my strength, and I kind of know who I am, and I know my own personality, and I'm going to play to it. Now, my orientation in the market is, what I try to do is swing trade around a core position. So I think that the really big money in the market is made identifying the true big winners, those special high conviction stocks that have something truly special that can really change the world. Kind of like what Jim Ropel talks about, and really capitalizing on those moves, which might be multi-year moves. And what I do is try to maintain a core position in those types of stocks, but trade around the core by selling into strength when I think a stock is extended, and taking advantage of weakness to add to my position or recover shares that I sold into strength. Generally, when I'm buying pullbacks, I already have a position in the stock. So I might buy at the traditional pivot point or alternative pivot, or maybe before the stock is breaking out. I'll talk a little bit about that. But once the stock is trending up and now supported by moving averages and different support levels, that's where I'll look to pyramid and add shares to my position. So let me preface by saying that nothing I'm going to say today is really that revolutionary. It's not going to be earth-shattering, But interestingly, nobody talks about buying weakness. We really only talk about selling weakness. And it's typical that we'll talk about buying the breakout and then moving up our stop, and eventually a pullback will occur, which will stop you out, and then you'll move on to another stock. And I've always thought it's curious that it's normal and constructive for stocks to pull back along the way. All stocks, all huge winners will pull back to the 50-day moving average on multiple occasions. So why not take advantage of those opportunities to add to your position and take advantage of people that are getting shaken out at those levels? So anyway, that's just a little intro into what I'm going to talk about today, and I will get started. So buying pullbacks, I think, can help boost your performance, overall performance within an O'Neill framework. And it can be an important part of your strategy, whether you are a swing trader or more of a buy and hold traditional can slim trader, where you're trying to identify the big winners and really hold them and pyramid into positions, or a hybrid approach like I have, where I kind of take advantage of the swing trading, which for me, the 3 to 6 weeks is kind of the sweet spot, and the traditional buying and holding until you see technical sell signals. Now, when I buy pullbacks, there are some general rules that you really need to follow, kind of an overlay rules. And these rules apply to buying strength as well as buying weakness. The general market has to be in a defined uptrend. You should be in a bull market that's strong and trending and forgiving. If you're trying to buy stocks on weakness or stocks that are pulling back when the market is topping or trending down, that can be very dangerous, because most stocks are not going to find support at those levels when the market is trending down. So number one, only do it in a strong uptrend. Two, not only must the general market be in a strong uptrend, but your stock also has to be in an uptrend. So yes, I'm buying weakness, but I'm buying weakness in the context of a rising stock. The way I define a rising stock or an uptrend is simply higher highs and higher lows supported by a rising 50-day moving average. If both of those things are occurring, then your stock is in a defined uptrend, and you can take advantage of pullbacks to support levels. You should have conviction in the stock. Now, in order for me to have conviction in a stock, it needs to be fundamentally strong. It needs to have a compelling story and great prospects. Because when you're buying a stock, when other people are selling, when you're buying, you're taking advantage of the weakness in the stock, you're kind of going against the grain, and it takes a lot of mental grit to go against the grain and buy when everybody else wants to sell. So you really need to know what you own and what you have, and have a tremendous amount of conviction. And for me, the chart alone is never going to give me enough conviction to trade a stock. I will never buy a stock on the chart alone. It has to have something that I believe in, and it has to make sense to me why the stock would go up. The stock should have good liquidity relative to the size of your account. It should be fairly easy to buy and sell because oftentimes the stock will not hold support, and you're going to have to reverse your position and get out. And this goes again for buying strength as well. So, I only trade stocks with sufficient liquidity based on the size of my account. And of course, it's going to vary depending on, if you're trading a 5-figure account or even a 6-figure account, your liquidity needs aren't going to be what a 7 or 8-figure account requires or more. So I'm typically trading stocks that are institutional type stocks, where institutions can come in and accumulate shares. And this goes hand in hand with institutional sponsorship, which is the I in can slim. We are relying on the big money, on the smart money, to come in and support these stocks at these stress levels. So if a stock has no sponsorship or no good sponsorship that a proven ability, I'm probably not going to play those names as hard. So yeah, you want good liquidity and you want sponsorship. And if there is no sponsorship, there's a good chance there's no liquidity, because those big funds require sufficient liquidity to build sizable positions. All right, so when we buy a stock, whether we're buying strength or buying a pullback, there are two objectives whenever we put on a trade. And that is, one, we want to increase the odds of winning, right? We want to put the odds in our favor that the trade will be profitable. And we always want to be able to define our loss in case we're wrong. So that's the risk management end of it. But both of these should occur. So the typical approach that we typically teach, and that is written in Bill's book, and that many of the speakers have talked about, is buying strength, buying when a stock is moving above an area of resistance, and moving to new highs, and typically with a rising RS line. And so a typical example would be to say, here's Coupa Software last April, broke out of a cup with handle base, and we would buy it breaking out of this handle here on an increase in volume. Again, buying at this pivot point is increasing our odds of winning because it's now cleared all the overhead supply. There's nothing in the way of it moving higher. And we can easily define our risk as the low of the, maybe the intraday low of this breakout. If our expectation, of course, is that the stock will continue to move up, but if it doesn't and moves down, we know we can sell the stock and cut our loss. And so in this case, the stock continued to move up and then consolidated for a few weeks and then began to break above resistance here. So we can pyramid into our position here on strength as it clears the resistance at new highs. And oops, and the stock continues to move up. Again, consolidates, gets support at the 50-day moving average and breaks out again. You can pyramid again, and then the stock finally corrects and breaks the 50-day moving average decisively on heavy volume, and you would unwind your position and move on. So that is a typical way that we trade, and it's great. It works great in a strong bull market. But the disadvantages of it are that you're always buying at new highs. So our cost basis on a relative basis, relative to buying maybe on a pullback, is going to be higher. And you're always competing with everyone else to accumulate shares at these obvious buy points when a stock moves above resistance. Every one of us, I'm sure, puts alerts pretty much at the same area on a chart. We want to be reminded that a stock is about to break out into new high ground. So to me, this is the obvious place to buy. We're competing with everyone else to accumulate shares, and the obvious doesn't always work so well in the market. And I would say definitely this year, and I would say even for the past 5 to 6 years, buying strength has not been the greatest strategy. I've seen more and more breakout failures, breakout shakeouts and fakeouts become more and more common. And so always buying kind of the obvious way, I think, has become more difficult. So the question is there an alternative way that will eliminate some of those disadvantages, but it still allow you to fulfill those two objectives of keeping increasing our odds of winning on the trade and defining our risk? And my answer to that is yes. An alternative approach would be to buy pullbacks, either initiating a position or adding to a position on a pullback. And typically I'm adding a position. I don't initiate positions as often on a pullback, but if I missed a stock, I will take advantage and initiate there. The advantages of buying on pullbacks is that you're going to get a lower cost basis relative to buying at new highs. It's going to be so much easier to accumulate shares when the supply-demand imbalance is moving in your favor. Everybody wants to sell, and you can, kind of stand there and soak up those shares easily. So when we're doing this, we're taking advantage of the fearful sellers who are getting shaken out of a stock at a support level. When can we buy on a pullback? Well, you can do it prior to the breakout while a stock is building a base along the right side, or you can buy it more typically after a stock is breaking out and now has certain areas of support along the way, whether they're moving averages or the top of prior areas of resistance, and we can buy that way. So let's first talk about buying a pullback prior to the breakout. So we're buying here when a stock is building the right side of a base. When we buy in this way, it's always best to wait for an upside reversal before you buy. So that's really your indicator of buying a pullback, multi-day pullback on a stock that's still basing or building the right side. You want to wait for the upside reversal because the upside reversal in and of itself indicates supporting action and a shakeout of the weak holders. It's preferable if that upside reversal occurs on heavy volume, and it's always preferable if it occurs at an area of support, but typically within a base that's still building, you might not have those areas of support. The way we define our risk on an upside reversal is that our expectation, of course, is that the stock will continue to move higher after the upside reversal. Just like if you buy at a pivot point, the stock should continue to move up. We know we're wrong if the stock breaks below the pivot because that's not normal action. Same thing with the upside reversal. We know that we're on the wrong track if the stock continues to move lower, and that's where we would cut our loss, and that's where our risk management comes in. So let's look at an example. This is Skyworks solution. This is last year while the stock was building its the right side of the base. Oops. After the COVID crash here. And you can see the stock is moving up nicely. It's now moved above the 50-day moving average, which is the red line on the chart. And it's now above the 200-day moving average, which is your blue line. But it's still not high enough to be a proper handle. Still not quite in the midpoint, above the midpoint. So we have a 3-day pullback, which ends in an upside reversal on an increase in volume. So you don't have to wait for the breakout. You can actually get started a little early here and begin your position here, setting the low of the intraday low of this upside reversal as your line in the sand of where you would reverse the position to cut your loss if it moves lower. With regard to cutting your loss, if there's kind of two schools of thought of whether you act immediately or wait till the end of the day. I think it's a 50-50 thing. I personally typically have the tolerance to wait toward the end of the day, depending on the intraday action of the stock. But I prefer to wait toward the end of the day to see if it's another shakeout. Some people just act immediately. I think it kind of has to do with your personality, what you're comfortable with. And so you can also buy in the handle if you get an upside reversal. So in this case here, we get another upside reversal on a slight increase in volume. And we can draw in the line up here where it's your traditional pivot point. And we also know where we're going to cut this portion of the stock if it moves back down. So now we already have 2 buys in the stock, and the stock hasn't even broken out yet. And if the stock does break out, we're going to add to it there as well. And the stock does break out. And so we would add there. And so we have 3 buys on the, 2 prior to the breakout, 1 on the breakout. And we have a nice cost basis because we got in a little bit early. And the stock moves up and consolidates. And you'll notice that during this consolidation, we have 3 pullbacks. Again, supported by the 21-day moving average, which I'm going to talk about in a bit, but that's the magenta line on the chart. And so you can take advantage of these pullbacks to the 21-day moving average on these upside reversals. And then if you like, you can also add and pyramid into strength as it's clearing these short lines of resistance. So that is kind of how I would normally trade a stock. I use a combination of buying at pivots and buying on the pullbacks. I'll buy each successive breakout above resistance to pyramid and each successive upside reversal. Looking at another example, this is Lululemon. You can see it had a huge 51%, 52% correction during the COVID crash, a very powerful bounce off the bottom, very heavy volume. And then you get this 5-day pullback, and it ends in an upside reversal on an increase in volume. Now, the stock at this point is still well below the 200-day moving average, well below the 50-day moving average. But because we can define our loss easily, and our expectation is that the stock will move higher, if you'd like, you can actually get started early in the stock and begin to build your position. The stock does continue to move up as we would have expected. It now moves above the 50-day and 200-day moving averages and is now high enough, slightly high enough to count as a proper cup with handle. And you can buy your position, add to your position on the pivot. Note that in the handle, we did not get an upside reversal to buy on that. So you don't always get what you're looking for, and if you don't get it, you don't get it. You just find another, you wait for the next opportunity. Now in this example, the stock moved up for a couple of days and then retested the kind of the pivot area and moved kind of back into the handle and gave you another upside reversal. Very tight action here, not great volume, but very tight action. So you can use this as another opportunity to buy. The stock moves up and breaks out again. So this is really like a second handle. And that's your obvious point to add to your position and buy strength. That's what we would normally do. But what happens is the stock again reverses and comes back in to the handle. So now we really have 1, 2, forming 3 handles here. You get another upside reversal, so you can add there as well. Now keep in mind, if all you did was do our traditional buying, so let's say you buy here on the first pivot, chances are you've gotten shaken out. You wait, you buy the second pivot. Chances are you got shaken out again. Are you going to be willing to buy the third? I don't know. A lot of people after 2 losing trades in a short period of time are going to give up on the stock, or they're just not going to trust the stock anymore. So getting started early and taking advantage of the upside reversals in the context of this uptrend, where it's getting support, will allow you to have a lower cost basis and allow you to survive some of these short little 1, 2-day pullbacks before the stock really even gets started. So finally, this last breakout works. We get a nice sustained uptrend for several weeks, and the stock begins to pull back and consolidate. Completely normal action. Note that the 21-day moving average is mainly containing most of the action here. You get these little shakeouts below it. But again, we get this upside reversal pretty much at the 21-day moving average, and you can add on these levels here. Little shakeout here below even this area. So it's shaking out and giving you opportunities to buy on weakness. The stock's about 9% below its high. And it continues basing and breaks out of a second stage base, or maybe even want to call it a base on base, and breaks out. And there's another traditional buy point where you would typically be buying. Here's how the stock ended up playing out. And you can see just multiple areas of buying on weakness, on upside reversals following, on these pullbacks, and buying on strength. And I will employ all of these areas typically when I'm trading a stock and managing my position. Finally, we get a heavy volume break of the 50, number of ominous sell signals here as far as heavy volume, one day losses. So enough to kind of push you to scale out of your position as it's falling. And finally, the decisive break of the 50, you I'm sure throw in the towel. And so when you are prior to the stock breaking out of a base, the only way you can really define your risk is by waiting for an upside reversal, because when a stock is still forming the base, it is typically trading below moving average lines, and those moving average lines may not even be trending up. So you can't really rely on them. So it's critical to be patient enough and wait for an upside reversal when you're buying before the breakout. So again, this was a Lulu example we just covered. If you did not buy on that day, if you bought, let's say, down here, or maybe the day before, where do you cut your loss? Like, there's no support area unless you come all the way back down here, and we don't want to wait for that. So the upside reversal in and of itself is supporting action and allows you to easily define your risk. So insist on waiting for that before you take a position. But after the breakout, once a stock is actually in a defined uptrend, there's going to be additional areas of support where you can define your risk. So it's not absolutely necessary to wait for an upside reversal in those cases. So the moving average lines that I pay attention to when a stock is in a defined uptrend are the 10-day moving average, the 21-day exponential, and the 50-day moving average. So beginning with the 10-day moving average, the way I use the 10-day is pretty much as a way to keep me in a stock, as opposed to an area where I would increase or accumulate shares. Because the 10-day is typically so close to the price action that unless the stock is extremely powerful and well extended above the 10-day, typically that the stock will be within 10% of the 10-day moving average typically. And when I'm buying pullbacks, I'm looking for something a little more substantial than that, maybe something in the 12 to 20% range. So, if I can find a stock, I think the sweet spot, I was to just study, and the average pullback was around 16 to 18%. So if I can buy a stock in that range, I feel like I'm doing pretty well. But typically the 10-day will be too close to that price action. So instead I use it more as a means to keep me in a stock, because I do have a tendency to get a little excited and lock in my gains a little bit too early. So Tesla, which was a stock I traded all last year, and I still have a position, is I probably made 80% of my gains last year, and it was a very significant year in Tesla. Tesla was by far my largest winner. And you can see when it broke out in December of 2019, it had an incredibly powerful advance. And the 10-day moving average, which is your green line on the chart, contained the entire move all the way up here to the top until it was finally broken out here. So at the peak, it was up 168% over 10 weeks, all supported by the 10-day moving average. So it could be a very powerful way to keep you in a stock, especially if you have a tendency to kind of get excited and take your quick profits. And you can see that during this move up, you had multiple upside reversals with support of the 10-day moving average, where you could have pyramided a little bit on those days. So the 21-day moving average is another moving average that I pay a lot of attention to. And it too will often contain a stock's primary advance out of a base. And it does usually a pretty good job of that. And because the 21-day is a little further away from the price action, you actually get a stock oftentimes moving down 10 to 15% or maybe a little more by the time it comes down to the 21-day, which is more in line with what I'm looking for when I'm trying to buy a pullback or recover shares that I've already scaled out of into strength. So going back to that Coupa example that I started the presentation with, if I initiate a position here on the breakout, let's say, again, I highlighted many of the typical areas where you would buy coming out of strength to add to position, but look at the 21-day, which is again the magenta line here, containing the advance all the way up to here. That's an 85% advance over 15 weeks, all supported by the 21-day. So you can see 1, 2, 3, 4 upside reversals with support at the 21-day, where you could have taken advantage of that momentary weakness and added to a position before you finally got a break. And then when you finally get that break, you can reverse some of these shares and make a decision. Do you want to hold your lower cost stock? Do you want to just take your profits in the stock or wait and see what happens to the 50-day? You can make your decision then. But again, buying the weakness on the upside reversals is going to give you a much lower cost basis and can always adding at new highs. And then finally, we have the 50-day moving average, which is our classic area of support that almost all large, big winning stocks will visit and revisit multiple times during a big run. I've been involved in creating many model books for the firm over the past 2 decades. And oftentimes that 50-day moving average or the 10-week line will contain a stock's entire advance from the initial breakout all the way to the peak. So it can be extremely powerful, and it's a great place to add to positions if you can tolerate, the pullback. And that's kind of one of the benefits of being kind of swing trading around a core position, is that by taking some profits into strength, you have a little bit more comfort when a stock is pulling back and you're now, your stock might be 20 or 25% off its high. It gives you a little more confidence to kind of go in and recover those shares because you've already locked some of the gain in. And I will always aggressively buy the first pullback to the 50-day. So this is C Limited, one of the huge winners of last year. It wasn't a stock I was involved in. I kind of missed it, never really entered it, but it broke out of this cup with high handle and had this enormous initial run post breakout. And you can see that that run was almost fully contained by the 10-day moving average all the way to the top. So that's an enormous run, all contained by the 10-day, which again is just a great way to keep you in a stock and allow you to maybe capture a gigantic gain where you would have ordinarily taken a much smaller gain just by, kind of trying to sell when a stock looks extended. It looked extended the entire way up, but it just kept moving. And you finally get this break of the 10-day, and then a break of the 21-day, and it then moved down toward the 50-day moving average. So this is your first pullback to the 50-day, ending in an upside reversal. Didn't quite get there, but it got close, ended up in an upside reversal, and that would be an appropriate place to try buying on the weakness. And let's see, at this moment, the stock was 17% off its high at the close of this day. So intraday was off over 20%. And from that level, the stock moved straight back up into new high ground and moved much higher very rapidly. Another example of a great stock last year that was supported by the 50-day moving average is Zoom Video. So Zoom breaks out of this cup with handle, nice little tight action here, and it moves up and gives you 3 opportunities along the way up to buy on pullbacks, each of which resulted in an upside reversal. So you had that pink day here at the 50-day moving average closing in the top of the range. You have this little day in here, which almost touched a 50-day closing near the top, and then another one here. All of these are sufficient shakeouts. I mean, if you're into the stock here and now you're down 27%, in, 5 days, chances are you're going to freak out. That's just what happens. So again, a swing trading approach where you're taking advantage of strength and buying weakness can kind of cushion that a little bit and give you a little more confidence to take the risk to buy on at these stress levels. And also look that if all you did was buy strength all the time, the way we traditionally would, you may have, even if you bought at the pivot, you may have been stressed out at these levels here and been forced to take a small gain. If you bought here, it lasted really one nice big day and then came into the 50 days. So you would have probably gotten shaken out on a buy over here. If you bought on this day, chances are you got shaken out. And finally, this one works. But more often than not, you find these stocks that shake out directly after moving into new high ground. And that's why, while I employ that method, I would much prefer to try to buy on the pullback at a stress level. Now, ultimately, the stock finally has a decisive break of the 50-day moving average, which is a very ominous sign and definitely an important technical sell signal. But I would say that if you have a large cushion on the stock and it's still midweek, if you have the cushion and the stomach for it, while it would make sense to sell at least some of your position, especially after it's already tested the 50-day successfully a number of times, you might want to wait till the end of the week to close out your position, because oftentimes the stock will look really terrible intra-week, but by the end of the week, it actually turns out to be an effective shakeout. So again, waiting till the end of the week will make it clear whether or not the stock is broken or if it's just shaking out the weak holders. Keep in mind that if a stock does look like this and decisively breaks a 50-day closing near the low of the range, it shouldn't get much worse. If it gets, you have to draw the line at some point. So if it's going to be a shakeout and come back up, it should come back up immediately, beginning the very next day. If the next day it breaks down even further, then I would be gone. I'd be done with it and just wait for another base to form. Now, and if the stock by the end of the week is 40% off the bottom of that weekly spread, is generally a good point to buy aggressively, because it was an effective shakeout that shook out the weak holders, and you can go in and take advantage of that. So the poster child for this kind of action for me is Acme Packet, which was a stock I traded aggressively during 2010 and 2011. It was one of the biggest winners during that time frame, moving up over 500%. And you can see that each time it pulled back to the 50-day moving average, it undercut it and looked terrible. On this day here, it closed at the low of the range below the 50-day. Over here, it had a kind of an upside reversal, and then the next day hit another low, closing in the upper part of the range. A number of days here, intraday below the 50-day, here below the 50-day. So it was an incredibly difficult stock to hold and manage properly, but the character of the stock was that it would shake out for several days under the 50-day. It never got too far away from it. So you can see that on those days that it broke the 50, it pretty much immediately came back up. So again, if it continued to break down, you know that it's not right. But I always have this in mind when I own a stock that's flirting with the 50-day moving average, because if you wait till the end of the week on each of these occasions, you can see that each of those 4 occasions turned out to be strong supporting action and a shakeout. So again, waiting till the end of the week with at least part of your position can keep you in a great winner. And again, once you lose your position in a stock, you lose some confidence as well. And it's very difficult for most people to cut a position on weakness and then buy it back on strength, especially given the fact that many times the stock will shake you out, kind of move back up, you'll get back in, and then it'll shake you out again. I might pull back to the 50-day again on multiple occasions. So, it's really hard to recover a position that you've completely unwound. So moving back to Zoom, and I was trading it during that time. By the end of the week, the stock actually moved up and closed 47% off the low on a pickup in volume. So it was, in effect, an effective shakeout. And look what happened after that. So the very next day, it gained strength and moved back up. And the stock really never looked back. It never really gave you a great time to buy unless you were buying it here. Just imagine if you sold it here and bought it here. And 2 days later, you're sitting with a loss. Probably would have cut your loss. So stocks are really tough to trade. They want to trade in a way, I think, to shake out the most amount of people. And so I always take advantage of the weakness when I have an opportunity to find my loss and give it a shot there. So in addition to the moving averages, you can also use the top of the prior base or consolidation as an area of support. These don't have to be, legitimate bases, that you would read in Bill's book. They can be short-term consolidations that even last a week or two. But you can see them on the chart. And when a stock breaks out of one of these short consolidations, you can use that peak as now a support level. So Shopify was a good example of this back in 2019. Once the stock broke out of the sideways consolidation here up over here, had a really nice stair-step pattern where it would move up, consolidate, move up again, consolidate, move up and consolidate, and it kept doing so. And so each time a stock breaks out of a little short consolidation here, I draw a line above that, where it's moving above resistance, and I carry it forward and see if that resistance now becomes support. And you can see on many occasions it did in fact act as support. And so if a stock falls back to that level, you can take advantage of that weakness and buy at that level of support. Now, if it fails, if it encloses well below it or begins to break down, you're wrong. And that's where you define your risk. You can even see here where you broke above this line and you get this super sharp 3-day pullback and you stop right at the top of the prior area of resistance and then move back up. So you can use these areas to buy on weakness, knowing where your level of support is. Ultimately, the stock peaks, comes back in, temporarily finds support at that line, and then breaks below it. And you can see it's also broken down below the 50-day moving average at that time. So you have two indications that the stock is peaked. So the question often comes up, should you always wait for the upside reversal when you're buying a pullback? And the answer is not necessarily. You don't have to. But to be honest with you, I think if you decided to insist on an upside reversal when buying a pullback, I think you do tremendously well. I don't always wait for an upside reversal. I'll sometimes just buy a stock that's coming into support, but it's not for everybody. It's more stressful and it's more difficult because when you wait for the upside reversal, that in and of itself is indication of supporting action. When you buy a stock that's come down to support but doesn't look strong, and when it looks weak, maybe closes at the low of the range, you're not seeing the supporting action yet. All you know is that it's come down and it should get support. And so that's a much more difficult buy. And I would say it's probably a riskier buy. But you have to do what you're comfortable with. And if you're comfortable with that and you have the cushion and you're disciplined enough to reverse a position if things go against you by a certain amount, then you can try it. But again, it's not for everybody. Again, the the upside reversal indicates supporting action, and it's easy to define your risk. So those are the advantages of it. But the disadvantages of waiting for a reversal day is that many times the stock will pull back and not have an upside reversal. So you may miss your opportunity to buy. You might not be able to get take advantage of all pullbacks if you're always waiting for an upside reversal. So an example would be Coupa. Now this is earlier in the move than I showed you in the previous charts. This is during 2019. The stock breaks out of a base on base or a second stage base, and it's moving up nicely, and it has this very sharp correction right back down to the top of prior resistance, which also coincides with the 50-day moving average. There is support here, but the stock isn't showing supporting action yet. There's no upside reversal. So it's a riskier buy. The next day, it basically slightly undercuts and shoots right back up super quickly. And I remember it because I was trading the stock during this time frame, and there's no way you would have been able to buy that stock on strength in the vicinity of the low. Not easily. It moved up so quickly. And so again, if you're waiting for that kind of nice, easy upside reversal, you might not get that opportunity, and you might not be able to take advantage of that momentary weakness at that level of support. Another example is Tesla. So Tesla, again, was the stock I traded most actively last year, and by far had the largest gains in. And when it, back in September, when we had that little kind of peak in the market, Tesla got creamed, moved down 34% in 5 days. Huge. And look at the action on this day. Is a gap down on huge volume, closing at the low of the range. So there's no supporting action there, but it came right down to the top of the prior base and the 50-day moving average. So similar to the Coupa example, you had kind of a double support there. I don't think a lot of people maybe had the guts to buy there, but I did. I was buying as it was coming in toward this level, trying to take advantage of this incredible weakness in such a short period of time. Now, keep in mind, I was scaling out of the stock on the way up, and I certainly did not top ticket, but I was selling all the way in this level and now taking advantage of the weakness and betting that it would find support at this level. And it did. It moved straight back up, again, without an upside reversal. Now, there's no problem waiting for the next day. You can buy on strength the next day, or even the next day, or the next day. There's no reason why you can't wait and do it. But again, there are advantages and disadvantages. If you buy on the next day or 2 or 3 days into it, and you get what often happens is another pullback to the 50-day moving average, chances are you're going to get shaken out of those shares. So, you might have a little more confidence because now the stock has shown support and is beginning to move back up, but you also risk getting shaken out again. So again, it's you can't have it both ways. If you try to get the lowest cost basis, you're taking on more risk. If you're trying to feel better about the trade and buy on strength, that can work well for you, but you still risk getting shaken out. So it's tough. The way I do it personally is I do all of them. I try to buy at the support levels. I try to buy upside reversals. I try to buy when they're starting to move back up, and kind of do a little bit of each because, we don't know what the best way is without the benefit of hindsight. So I kind of try to do a little of each. Another disadvantage of waiting for an upside reversal is not only is it possible that you don't get one, but let's say you do get one and you buy on that day. Sometimes the daily spread is so great on the upside reversal that you don't definitively know that you're wrong until you're down over 7 or 8%. So you might have a really wide daily price spread. And if you wait for the stock to undercut the intraday low of that day, you might take a much larger loss than you were planning on. So DraftKings is a good example of that. Super powerful stock last year, moved up super sharply, amazing, all supported by the 10-day moving average for the bulk of the move. And then finally, you get your first pullback to the 50-day moving average, which is a buy point. I mean, I would definitely want to buy and would be buying on that day. I wasn't trading DraftKings, but there's no question that if I wanted the stock, I would have bought it on that day. But the stock was already up almost 9%, close about 9% off the low. So you don't know that you're wrong until you're going to take a 9–10% loss. And in this case, the stock did fail. And you might be forced to take a loss larger than what you're comfortable with. Okay, so I think we've exhausted the upside reversal. As far as buying on weakness without waiting for an upside reversal, 3 ways to do it. You can do it as the stock is approaching that level of support that you anticipate it's going to hold. You can actually wait for it to hit that level of support, maybe put a buy limit in, or you can wait for it to actually get support and begin to move back up. And again, each of these methods has its advantages and disadvantages. If you're trying to buy as the stock is actually falling, the advantage is that it's super easy to accumulate shares because people are panicking. There are many sellers there, and it's super easy to pick up shares. And potentially, you can get a better cost basis if the stock ends up finding support and moving up. The disadvantage, of course, is that when you're buying on the way down, you're trying to catch a falling knife. And we know that's dangerous and not advised. And so if the stock continues to fall, you can be in a world of pain and might take a larger loss than you're comfortable with. The when we're buying a stock that's coming down to support, whether it's a moving average or the top of a consolidation, our expectation is that it's going to stop at that level. So that's where we're going to draw the line in the sand. It's like slightly below that level. Or we might be hoping that it's going to stage an upside reversal. So this is where we will define our loss. When I'm buying a stock that's falling, my objective is to try to get in, kind of average in when I'm done averaging in this pullback buy. I'd like to get within a fairly close percentage of what turns out to be the ultimate low. I'm not going to pretend I'm going to bottom tick the stock. It's never going to happen that way. But if I can get in, let's say a stock is correcting 20%, if I can get in within 5 or 6% of that low on average, and it holds there, then I feel I'm doing really, really well. So that's the objective. So I'll get into something else in a sec. But so your rules when you're buying a stock is falling is don't be too eager to buy on the way down. It's because it is risky. And you want to be very patient. You want to wait until the stock is truly approaching that level of support. You don't want to just get excited and buy early in the move down. And you want to buy really slowly and just teeny weeny amounts of shares. You don't want to start out buying a lot. Start out buying a little, a fairly insignificant part of your account, because if you're wrong and you take a decent sized loss, at least it's only on a very tiny part of your account. Keep in mind that true pullbacks in leaders take time, at least 4 to 8 trading days, sometimes multiple weeks. It's very, very rare you get a 1-day down and that's all, even if it's a substantial hit. So you want to be patient when you're trying to buy the pullback, and you want to be able to define your loss ahead of time. So if the preferred method is that it's going to be a level on the chart. And as I mentioned, there's multiple areas of support within charts, whether you're talking about moving averages or the top of prior bases. So you need to know what those are ahead of time and be comfortable, kind of define what percentage loss you're willing to take, and then buy within that percentage of those support levels. So you can define your loss. So defining your loss is going to force you to determine where the support on the chart is. If you don't know where that point is, then don't try it. Okay, if you look at the chart and you're like, I'm not really sure where the support is, then don't try to buy on weakness. I talked about being patient. You don't want to get started too early. Again, when I'm buying pullbacks, particularly if I'm just waiting, if I'm buying on weakness while stock is still moving down, it's got to at least be a double digit, at least a 10% off its highs. If it's, many stocks will doodle around and move down 4, 5, 8% off its high and continue to move higher from that point. Those aren't the pullbacks I'm going to get involved in. I'm looking for more sizable pullbacks, particularly if I've already sold and scaled out a part of my position into strength. And I never buy all at once, whether I'm buying strength, buying weakness, or even selling strength or selling weakness. I never do the entire trade at once. I always use a scaling approach. When I'm scaling into a stock on weakness, I'm using a reverse pyramid. It's the exact reverse of what you do when you're pyramiding a stock that's moving up. So, in a stock that's moving up, in an uptrend, we always add fewer shares so we don't mess up our cost basis. When we are trying to buy a stock on weakness, you want to start with the tiniest positions and add as the stock is moving closer to your support level, because your amount of risk as it moves closer and closer to support is less. You've already defined that you're going to cut it if it breaks down below a certain level. And so as you get closer and closer to that area, you can take on a little more size. I oftentimes will put limit orders at the points where I'd like to pick up shares. And you must always know what your maximum position size is going to be. You need to know ahead of time how much you want to buy. If you're kind of making it up as you're doing it, and the stock continues to move down to your support level, you might end up buying much more than you want. So always be cognizant of how much you're trying to get on the pullback. So Pinduoduo was a stock I traded multiple times during this time frame. And so it broke out of this consolidation here. Really nice breakout, and then a pullback, kind of a shakeout right back down to the pivot. And then it went on an extraordinary run, all supported by the 21-day moving average. And as the stock was moving down toward that 50-day moving average, again, it's the first pullback to the 50 is where I'm almost always going to buy that. It's kind of typically a gimme, and great leaders almost always have at least one successful test of the 50-day moving average. And if it doesn't work, it doesn't work. There's no guarantees. But I think you're putting the odds in your favor that the first pullback should work. So if I'm trying to buy within, let's say, 5% of where I would cut my loss, and let's say that would be around 75. So I would maybe start buying here around 80, but really small, incremental, because I'm actually expecting the stock to continue to move lower. If I bought it on that day and it started to move up from that point, I'd probably just be happy with the small purchase that I was able to buy, and I'd wait for a different kind of entry point because I really am looking for the stock to actually come right into that level. So the next day, as it moves a little bit lower, you can add to your position. Now it's really tight. You're really close to your support level, and you know where your risk is. And then finally, you get what you're hoping for. You're hoping for an upside reversal and a test of that line. So the stock comes right into the 50-day, stages an upside reversal on a rise in volume, and now you're set. Now that's where you would really accumulate the all the shares you'd want on the pullback, you're 20% off the highs. So that's a sufficient pullback. If you're a swing trading and trading around your core position, you've been selling on the way up. And so now you have an opportunity to recoup those shares. And the next day you get a really nice strong move off the 50-day. You can also buy there too if you choose. You suffer the risk of you take on the risk of maybe another another shakeout to the 50-day, or maybe even just a failure of the stock. But those are the risks you take. In this case, the stock did continue to move up strongly to new high ground. So that's how I would play that type of falling. A stock is actually moving down. If I didn't want to wait for the upside reversal, I'd try to buy close to the support level with the expectation that it will hold at that level and bounce. All right, so that's my presentation. So just to conclude, adding this is kind of to your bag of tricks, buying on the pullback as opposed to only buying on strength and buying above resistance can, I think, improve your overall result. It can give you a little more confidence to write out the highs and lows within a stock and improve your what otherwise would be your cost basis of only buying on strength. It's really critical to be patient and wait for the stock to approach the support levels. And so you need to know where they are and be really, have a high level of conviction in them, and just be educated. Know where the support is in your chart. And again, if you can't figure it out, don't do it. Wait for another obvious point to buy. It's always paramount, whether you're buying strength or weakness, to define your risk. And we've had many of the speakers this weekend talk about risk control. And just like buying strength, you know where you're going to cut your loss. Similarly, if you're buying weakness, you need to know where you're going to draw the line. Discipline always trumps conviction. Doesn't matter how much conviction you have in the company or in your support levels, in the technicals, fundamentals. If it breaks a level, if it breaks an expectation, you have to have the discipline to cut the loss and move on. So Richard, that's it. See if you're there. Oh, hey there.
Yep. First of all, Charles, really excellent job. I think buying pullbacks is something I personally want to learn more about. And no, this was fantastic. I'm sure everybody watching agrees. So first of all, thank you so much for this excellent presentation.
Sure. Yeah, of course.
I've seen a ton of questions in the chat, and I guess we'll get started with the Q&A if that's all right with you.
Yeah, of course.
So the first thing I want to ask you was, one, do you take into account the kind of velocity of the pullback back into the either prior level of support or moving average, whatever you're doing the pullback by based off, and also how short a pullback will you take? I know you said 10% from the high, but does it matter the number of days it's pulling back?
So with regard to the kind of the velocity of the pullback, I've showed a number of examples. Sometimes the pullback looks incredibly scary, like that Tesla pullback. And sometimes it looks orderly in this low volume. We always prefer, when a stock is in an uptrend to, we always say we want the stocks to move up on heavy volume and then consolidate and move down on lighter volume. And so if you have a controlled pullback to a moving average level or a different area of support, that's preferable, but that's not what you always get. Sometimes you get a very volatile and kind of panicky drop to a support level. It's hard to know, obviously without the benefit of hindsight, whether it's a sell signal or a buy signal. That's just the way it is. So that's why when I talk about some of the general rules that you need to consider before you even attempt this, is they have to be high conviction stocks that you really believe in, that have the sponsorship and the support and all that stuff. I would prefer, of course, for an orderly, lower volume pullback. But again, in reality, you're not always going to get that. But you know what? You can always choose, if that's what you're comfortable with, insist on that. and any other pullback that looks a little bit too volatile, you don't have to trade those. You know, I think it probably would benefit you from looking at a number of big winners and chart out their course of their moves and look at the pullbacks and how they occurred. And I think you'll probably find in most cases a kind of a equal representation of orderly pullbacks and ugly pullbacks. And you know, in the context of a large uptrend, they're both going to work, but they don't necessarily feel good buying them. I probably have a little more risk tolerance than most. So I'll kind of, in a way, you might say, well, the orderly pullback's preferred, but it's a scary pullback that shakes out the most number of people.
Right.
So again, because I'm a little bit contrary in the way I trade, I don't mind taking advantage of the panicky people.
Right.
So I might take a little more risk, but it might be a little bit more of a risky strategy. With regard to the number of days or the percentage off high, I've learned painfully over time to try to be a little more patient, because I used to say, oh, here's my opportunity. You know, I sold it, you know, 2 days ago, and now it, you know, it's down 10% or down 12%. And I start recovering my shares, and next thing you know, the stocks move down 20% or 25%. And I'm like, well, you're kind of stuck in no man's land. So I think it's really critical to be patient enough to wait for the stock to approach a support level, because I used to not do a great job of defining my risk. I would just say, well, you know what, I'm better off than I would have been if I had not sold, and now the stock is, you know, I've already sold it and it's lower. So worst case scenario is I'm better off than I would have been if I had held the stock. That's not really, I think, a great way to play it. You want to really insist on the stock moving down to your levels and be really close to them. And if it doesn't happen or you miss it, then that's okay. You get the next one. You don't have to, you're not going to get every one of them.
Perfect. And could you clarify where you place your stop on an upside reversal entry? And also, are you treating that buy as a separate buy, or are you taking that into account with your overall cost basis?
That's a great question. Okay, so to be clear, the where you set your stop on an upside reversal is a breach of the intraday low of that day. Now, I mentioned you can either, if it does breach that intraday low, some people will sell immediately and maybe set a stop below that, which I think is a little bit obvious, because this is kind of in my experience, where you set your stops is usually where you get stopped. So you can do that, or you can wait and see how the stock is trading. And if it's just a quick little shakeout below that level, sometimes you get an upside reversal, and then the next day you get a breach of that upside reversal with another upside reversal. So you kind of get kind of a double confirmation of the shakeout. And so if I get that, I'm going to hold the stock. But you're taking more of a risk. I mean, if the stock gets weaker and weaker throughout the day, you're going to take a bigger loss than you may have wanted. But that you can play it either way. I think it's a 50-50 thing. Do what you're the most comfortable with. But yeah, that's where you set your loss. And the other question on my kind of, do I consider this on its own or part of a larger trade? So I always, this is a really good question. When I'm trading a stock, particularly around a core position, I never forget the fact that I've already locked in a gain and I have a cushion.
Mm-hmm.
And so even if I'm have a loss on this pullback buy, let's say I buy it approaching the 50-day, and now I'm down 2, 3, 4% on the stock as it's coming down to that level, I still have a cushion in the stock. You know, I've still mathematically, I've made money. The money's in my account. And so I always consider it in the context of my entire position and trading in the stock. I don't just look at that as on its own.
And on those add-on upside reversal buys, those pullback buys, compared to your first initial buy, whether it's the base breakout or whatever the standard can slim type buy is, how much of that total position that you want allocated to that stock are you buying at each one of those points?
Okay, so I think you have to determine how heavy you want the stock to be in your portfolio. I take pretty concentrated positions. So if I have, it's also going to depend on your level of conviction,
Yeah.
but you don't want to get too top heavy. So, you know, if you start out with, let's just say, a 15% position, and you want to get it to a 25% position, you start to take advantage of those pullbacks to add a few percent here, a few percent there. And then at some point you get to a level where you're like, okay, I have enough of it. I try, even though I'm buying on weakness and buying pullbacks, is still lower than my initial entry point if I bought coming out of the base or if I bought prior to the base on the right side. So yes, I have a great cost basis, but I don't want to completely destroy that cost basis by continuing to add even on pullbacks. So you know, buying on the pullback will give you the opportunity to add more shares without ruining your cost basis, but you're still buying higher than what you have. So you still have to be careful with it.
And on a shakeout below the 21 EMA or the 50 SMA, whatever the moving average is, are you waiting for the close to buy your shares, or as soon as you reclaim that moving average value, that's when you place your order?
That's a great question. Normally, I'm when a stock is around these kind of pivotal points in the chart, I'm looking at the intraday action and I'm evaluating it. So if I see a sharp shakeout below that level and immediately I see volume coming into the stock, I'm going to kind of assume that the stock is going to move back up, and I'll try getting in early. I don't necessarily want to wait until the end of the day.
Yeah.
Where the stock proves that it was in fact an upside reversal. But you're always taking more risk when you're doing that. I mean, if you were to wait until the end of the day, I think you'd probably be fine. But again, you can't have it both ways. If you wait till the end of the day, you have more confirmation that you're right, but you also have more risk of, you're going to take a larger loss if you're wrong. So again, I don't pretend that I can time these things perfectly or even very well, to be honest with you. So I kind of employ a little of each. I'll buy at the 50-day or as it's coming up above the 50-day. And if it results in an upside reversal by, the close of the day or as the day is drawing toward its end, I'll get a little more aggressive.
Perfect. And once the stock has an upside reversal and you've entered your position, and it follows through the next day, are you adding maybe through the high of the upside reversal day? Basically, are you adding on that follow through the confirmation day after the upside reversal?
Sometimes I think the way I'm oriented, especially lately, because I've seen that I've become more, that's the word I want to use. I've become more comfortable not chasing and not, if I've taken advantage of that pullback, I don't want to kind of ingratiate myself by continuing to add to it. I've accomplished what I wanted, and I've gotten that low entry. I might add a little bit more on the next day, or if it continues to prove itself. But I'm always cognizant of the fact that a stock can always not either fail or retest the 50, and that happens more frequently than we often think. So I don't want to get stuck determining what to do with those shares. So if I'm right immediately, I might add a little bit more. But if it's working, I'm usually just happy with what I have and that I did it right, and I let the stock play out.
And I thought this is a good question, kind of overall market related as well. When do you stop buying pullbacks? Because either of negative action or anything with the overall market, the way market leaders are acting, what kind of is your guiding principle when it comes to that?
So that's a really good question. Well, remember the general overlay rules is the market has to be in a strong uptrend, and it's got to be a forgiving market, because a strong forgiving market is going to allow you to get away with a lot more. So you don't want to try this if your market is weak or beginning to break down. If that starts to happen, or if I see evidence that my win-loss percentage is starting to get worse, And normally when I'm on and I'm trading well, I don't have a lot of losses. I mean, I have gain after gain after gain, and with this, a few intermittent losses. But when things start to change and the market's rolling over, if I haven't rotated well with the market, I'll start to see loss after loss after loss. And that's my best indication that something is happening in the market. Either the general market's getting weak and everything's moving down, or we may be rotating sectors and I'm in the wrong stuff. I think that's one reason why this year has been quite difficult, because we're in a bull market. I mean, you can't say we hit a new high and not admit we're in a bull market, but the market for the O'Neill type stocks and growth stocks went through a bear market. And so if you didn't transition quickly out of those and into, kind of the reopening trade and kind of reinflation type stocks, then you might not be doing so well. So, the best kind of market to employ a pullback strategy is a forgiving market that rises all boats, not a rotating bull market where you've got to be in the right place at the right time. So yeah, I'll look at my other stocks and I'll look at the sectors, and if things are breaking down and getting weak and breaking down below levels of support, then I'll stop employing that strategy, because I'm getting indications and clues that it's out of favor. And I won't, once you see enough evidence that support is not working, stocks are not holding as support, you definitely don't want to try the strategy, because you're going to lose and lose and lose.
Right. And I was wondering if you ever played pullbacks to the 200-day moving average, because looking at the Tesla chart last year, it pulled back right to the 200-day, had a nice upside reversal, and it also was the confluence of the prior base high. So I was wondering if you ever looked at that as well.
I normally don't buy off a 200-day, because at that point, the stock is no longer in an overall uptrend on a shorter term basis. It's more of in a base building period. I do still have a core position in Tesla, and a lot of bad would have to happen for me to really unload that stock. I think personally, I think Tesla's a stock I'm treating differently than pretty much any other stock I've traded in quite a long time. And again, last year was such an extraordinary year, and I did so well with it that a lot would have to happen for me to really mess it up. But I normally don't do that. I normally don't buy off the 200-day, but I guess with regard to Tesla though, the way I'm treating Tesla, if I want to get specific about Tesla as opposed to just buying pullbacks, is.
Would you like to pull up a chart if you want to, or I can pull up a chart?
Yeah, pull up a chart if you like. I have Wanda I can open, but
I can pull up Market Smith if that works for you.
Okay, yeah, that's fine. But it's really more of as we're talking about Tesla, and it's not so much the chart that I'm focused on. It's more fundamental than that. And so I consider Tesla as kind of an Apple-like stock, an Apple and Amazon. I think it's got that kind of potential. And so I did a study last year, and as I've been trading it, of Apple and Amazon, and compared it to Tesla. And both Apple and Amazon have had basically 17-year moves since 2004-ish, around that point. And I did really well in Apple. I mean, during 2004, 2005, 2006, made a ton of money in Apple. But I didn't make 250-fold. And I don't know anyone who did. So I think you have to, sometimes you can kind of mess up your own position by over trading. And so I feel quite fortunate that even with the trading I've done in Tesla, I haven't really been able to improve my position from what I held, but I haven't ruined it either. I've, my timing on scaling out into strength hasn't been that great. My timing on getting into weakness hasn't been that great. But overall, I'm not worse off than I would have been if I just held it. So I kind of feel fortunate that I didn't mess it up. And it's really interesting. If you look at Amazon and Apple, and again, I'm looking at, what the similarities are. They have iconic leadership, that, truly innovative, amazing leadership. They have incredibly huge end markets. They're by far they have the innovation and the leadership in the product. And there's just so many similarities. And so I don't want to mess up another Apple. Like
Right.
I want to make that 100-fold move. And so I'm afraid if I start getting too cute with it, I am going to mess it up. This is kind of maybe a little bit interesting. I was looking at Apple. So over the last 17 years, Apple has had 10 corrections between basically 25 and 50%. I think I actually wrote it down here. Let's see if I have it. So yeah, since 2004, it's been up 250-fold. Okay, from that kind of initial breakout back in like April of 2004. It's had 10 bases of 25% to 59%. Okay, but of all the years that it's traded during that time frame, it's only had 3 down years. So you've had these enormous, bases. The average or median base in Apple is about 37%. So that's a pretty bad, it's a fairly deep base. I wouldn't necessarily want to sit through that. But by year end, it's had 3 down years. It's had 2008, which was kind of a,
Extraordinary. Yeah.
extraordinary bear market, which isn't something you see too often. And then in 2015 and 2018, it was off 5 to 7%. So I'm kind of looking at it and saying, well, you know what? Tesla's off a lot, right? It came down like nearly 40%. I think it came down 40%. That's pretty bad. But for the year, I'm not really down on it that much, from the beginning of the year, because it went up first. So I'm kind of sitting with my Tesla. And I'm just going to be patient, and I will add to it again when I think it's come out of here. I think the 200 days probably, if you're super long term, I think it is okay to probably buy this one special situation. But I have enough of it. I don't really need more of it. So I'm not really taking advantage of that right now, but I'm not selling it either. I'm maintaining. And same thing with Amazon. Amazon also has had a gigantic run over those years. It's had more down years than Apple, but once a stock is up and out, unless you have a tremendous bear market, it's pretty rare for it to have a really, really bad down year by the end of the year. You might have these bad intra years and these bases that are down 30 or 40%. On average, the average to median drawdown for those two great stocks is in the mid 30s. So Tesla's done that. I think it might get worse. Who knows? I mean, there's so much negativity around the stock. It surprises me. Not sure why that is, because they've got the biggest end markets. They're in all the areas I'd want to be in: alternative energy, electrification of vehicles, AI, autonomous driving, and who knows what else they're going to come out with. And that's just what we know about right now. But 5 years from now, there might be a completely other new line of business that they can leverage. Insurance. So I don't really know why there's so much kind of anger in a way and disbelief of the stock. But to me, it's this is, I'm hoping, 10 years from now, this could be the one that I actually got to hold for the big move. And again, we're really fortunate last year. How often do you see a stock go up, 7 or 8-fold? So if you're able to capitalize on that, now you're sitting with this big gain. You can kind of just sit, kind of what Jim Ropa was talking about, or even maybe what Bill O'Neill was talking, would talk about, is really trying to leverage a big winner. So I'm playing that one differently than all my other stocks.
Perfect. And you said that 10% is kind of the minimum for a pullback that you like to see. Is there kind of a maximum pullback to the 50-day or something that tells you there's a little bit too much weakness there, like a UPST? Oh, that's here we go.
Yeah.
It's having a really sharp pullback here, down, I think certainly more than 10% from its high.
Oh no, it's down about 35%, similar to that. I have a position.
Yeah.
And to be perfectly honest, I was buying it on Friday as it's approaching that day. It's pretty bad. It's pretty scary. I'm not thrilled with it, but they have a lockup expiration on Monday, and so it kind of makes sense that the movement is done what it has. This has been one of those stocks that buying strength hasn't worked. Buying weakness has worked, but we don't know if it'll work this time. I kind of look at it a little bit similar to Path. Path also had a lockup expiration, and you can see what happened. Or maybe it was the earnings, but yeah, I guess it was the earnings rather. But you can see how it you had that sharp upside reversal. I'm kind of expecting that it's pretty normal, I think, for stocks to come in down into the lockup and then get support. But if it doesn't, I'm going to have to sell it. I mean, I've traded the stock and I've sold into strength a number of times. But yeah, it's been a pretty bad, dramatic pullback. And if it wasn't for the lockup, I think I'd be even more uncomfortable with it. But it has all the other elements that I like. And if you pull up a weekly chart on UPST,
yeah, I'll bring that up.
It has the story. It's AI. It's come down to that 50-day moving average. And I've rarely seen an IPO have these types of volume characteristics besides this past week. Again, it's the week moving into the lockup. The tremendous upside, skyscrapers, blue volume in the move, and really the absence pretty much of the red volume. I think it's pretty extraordinary. And how many IPOs and high growth stocks do we follow that actually have earnings? I mean, this stock actually makes money.
Yep.
It's got everything's moving in the right direction. And so it's a stock I have conviction in. It's AI related. I think artificial intelligence is going to be one of the huge kind of thematic categories over the next decade. And again, it's anyone's guess what's going to happen. If it fails, you can just wait until it, bases and comes back. I have no idea what's going to happen, but it's given that the growth category is starting to come back, at least it has that in its favor too. Now it's possible that, the ARC type stocks, pull back again, or they're not ready. I mean, they've gone through a bear market. Maybe it's not over, but we are seeing evidence that those types of stocks are beginning to pick up. Yeah. So I don't know. I think I'm going to take a shot of a stock that's down 34% in 5 or 6 days, sitting at the 50-day. I'll give it a shot, but I admit there's no supporting action at the moment, just a support level.
And where did you start your position on UPST? And also, where's your stop on any position, any stock that you bought against the 10-week last week?
So my stop is going to be what I would expect to happen is a stock to kind of open lower and then reverse up. If we kind of open down or go down and close below that
this right here?
Well, I'm expecting it to come pretty much down to that level. The 123 pretty much coincides with the 50-day. I think I showed you a number. The Coupang and the Tesla both had a similar setup where the 50-day and the top of the prior base coincided. I would expect things to be weak in the morning for sure. and then reverse. If they don't reverse and we close down for the day, I'll probably call it quits. And I was buying I was buying the day before here, up near the 21-day moving average, thinking it would get support there, and it didn't. Again, just buying small and incrementally, and I added as it came closer and closer to the 50-day.
Could you talk about where exactly? Because I can't see your cursor, or maybe you could use the zoom
okay.
tool.
Oh, let me see. How do I do the zoom tool?
If you go up to view options,
Yeah.
you can click that and click annotate. And then if you go over to
mouse,
I don't think I can see mouse, but if you can choose an arrow, that would be great.
oh, awesome. Can you see that?
Not yet. If you go view options, annotate, stamp, no, draw, and then select the arrow. Then you can put arrows on here like this.
Oh, cool. Okay. So I began buying. Oops, how do I reverse that?
You can clear it. I can't. Oh, yeah, I see it's coming on right now.
So as it was coming down, the first level of support was a 21-day moving average, which is, you know, I started buying small there, and that didn't work clearly. And so as it was approaching the 50-day moving average, I've been buying it in here.
So you had no position before this?
I had sold it. So I've already bought and sold it a number of times, you know, profitably on these pullbacks in here and in here. I sold a little bit, you know, I didn't take advantage of this full gain here, but I've been selling it, kind of buying the weakness here and selling the strength. I actually traded it.
Are you talking about here? Are you talking about here?
I'm talking about recently here. Oh, darn it, I keep drawing these wrong. I'm talking about buying these pullbacks here.
Gotcha.
There we go. And selling these little pops here.
Gotcha.
But even in here, I was buying it in here and selling it. So I've kind of locked in. I wasn't trading it around here when it broke the 50-day. You know, it kind of was all over the place. It reported those amazing earnings, but I didn't initially play that too. It just moved so quick, and I hate to buy the stock. You know, went from 80 to 190. You know, in a number of weeks. So you know, if you don't get started early, it's just too volatile a stock, I think, to chase.
Yeah.
So but I've made some little quick short-term trades in it, and again, it's you know, trying to take advantage of what I'm hoping is, you know, a brutal sell-off back to that moving average line. And again, anyone's guess what's going to happen. So that's why I mentioned that, you know, if all you do is wait for upside reversals, like, and to be honest here, that was an upside reversal, and that was an upside reversal, and they both worked. If all you did was wait, can you see where?
No, I didn't. I'll erase all these current arrows, and then you can draw. Go ahead.
So what did I do to, was it stamp? No, not
yeah,
stamp.
if you go to draw.
Yeah, draw arrow, got it, okay. Upside reversal at the 50-day, and kind of this is like a shakeout below this level here, and this upside reversal here. So, sorry, I didn't point very well right there. Again, if all you do are wait for upside reversals, which is a supporting action, you're probably going to be well served. And, you know, if you bought either of those, you would have been really greatly rewarded. So, you know, you don't have to try this a little bit more risky approach of buying at the support level, you know, kind of crossing your fingers. But, you know, if you're oriented that way and have the stomach for it, you can give it a shot.
Yeah. Did you buy this 80.85 upside reversal here?
Which one?
This one right here.
I did not buy that one. I bought but I did buy the previous one.
Gotcha. I was going to ask you how you handled earnings if you did that.
Yeah, no, well, I didn't want to hold it into earnings, especially since it was, you know, well below the 50-day moving average. So I thought, I think, you know, truth be told, you know, that was super hard, right? You know, it shoots up on earnings and then shakes you out and then moves up again. And that's just the character of the stock is, it's really hard to trade it, you know? So, I mean, I think, you know, in a sad in a way, because this is a high conviction name that I would love just to hold because I believe in it. And I think, it's got the fundamentals, it's got the N in CanSlim. It doesn't have the greatest mutual fund sponsorship, but Dan Loeb at Third Point has a big position in it. Soros has a big position in it. So, there are some smart people that own the stock. And I think, this can end up proving to be a big winner. I think it's in a space that's ripe for innovation. And they're, I think, the leader in the space. And I do like kind of fintech oriented companies. So it has a lot going for it, but we're in a pretty difficult market. And again, this has been almost an impossible stock to trade well because, if you bought it here, oops, I keep doing the arrows the
Here,
opposite way.
I'll clear everything for a second. There you go.
Okay. If you bought it there, that was your pretty basic buy
Through
point,
here.
right?
Yeah.
And if you bought it there, you definitely got shaken out. And then if you gave it another shot, you got shaken out again. So this is a stock that is clearly buying strength hasn't been working too well. So I'm trying the opposite. I've been profitable in it, overall. But if tomorrow doesn't work out, I'll be down on it. So, overall, I'll be down on it. So anyway.
And are there any other high conviction names or stocks that recently you've made a good pullback buy that you think would be good examples?
Yeah, one of my biggest positions, my second largest position actually, is SBLK, SBLK.
Oh, yep.
So, I did a pretty good job of transitioning from growth into that reopening trade this year. And so Starbulk is the one I got involved in. Let's see, over here. It's one I've actually traded particularly well. I held my shares and bought more here on the 50-day and bought more here. Oh, darn it. Bought more here as it was breaking above this ledge.
Right.
And I bought more here. And last week, Thursday, Friday, I was locking in some gains. But I actually think it has the potential to go quite a bit higher. But again, it's a large position, and I thought, why not, lock something in? I mean, it's over 20% off this recent low. So that was, I think, a particularly good buy off the 50-day, and high conviction name in an area that's benefiting now from the reflation trade. And it's you can just look at the fundamentals. Finally shipping after over a decade of terrible performance. I mean, I remember I played the shipping stocks back in 2007, and they all fell 90 to 95% from those levels. So there's many kind of the economics and the dynamics of that industry are quite a bit in favor now, because there was way overbuilding of ships during that time period in the 2007, 2008. It's a glut of ships, all benefiting from the emerging economies, transitioning to a more protein-rich diet. You had, grains, you had China, you had coal, you had all these things. Dry bulks were really hot. And then in the 2008 collapse, they really got slaughtered, and they've been scrapping ships during that entire time frame. And it will take some time for the shipping industry to really rebuild. And so the supply demand dynamics are kind of in favor now. The stocks are profitable. The Baltic Dry Index has had a huge year. It's up, I think well over 200% just this year. And these shipping companies are finally profitable and are beginning to pay dividends. So, these turnaround plays can run for quite a while and make pretty gigantic gains. So honestly, if the stock doubled from here, I wouldn't be surprised. So I plan on keeping a core position in this stock. It also has, interestingly, the largest owner of it is Oaktree, which is a value investor. So, this is a stock I actually have mentioned a number of times on IBD Live. And, thankfully it's been one of those that have been working.
And what makes you scale out of stock to potentially buy it on a pullback later?
So that's that's a really great question, Richard. I was going to do a workshop on selling strength.
Yeah.
And so I started to do, I kind of do it on feel. And the truth of the matter is, I don't do a great job of it. It's based on feel. Selling into strength is so much more difficult than buying weakness, because when you're buying weakness, you have support levels, you have, so many other things you can rely on. But when you're selling strength, you have no idea how far a stock is going to go before it pulls back. You could wait for maybe a downside reversal. I did it again, like over here.
Right.
Here's another downside reversal over here. You could wait for that. I think that's an effective way to perhaps begin to sell, because your expectation is for further weakness. But other than that, maybe an extension over the 10-day moving average or 21 or 50-day moving average. But the most powerful stocks will defy that and get quite a bit more extended than you can imagine.
Yeah.
So, the truth of the matter is, I don't really have a great way of doing it. I don't think I do it particularly well. Like I mentioned to you, like Tesla, which had such an enormous run. All last year I was so cute with it, selling strength, trying to buy weakness. But by the end of the day, I think I would have had similar performance simply holding the stock without, gigantic capital gains tax I have to pay. So, one of the things I've actually done this year is at the beginning of the year, when I realized what my tax bill was, I've really questioned how great I am at all this kind of swing trading. I mean, I've kind of been successful with it, but in if you mishandle a really big winner, maybe it's better just to hold those super high conviction names. And so I actually bifurcated my account, and I kind of took half of it and put it in Tesla, and the other half I'm trading actively amongst, various stocks, including the UPST and the Path and the Starbulk. And kind of curious to see after 1 or 2 years which account actually has more money after taxes. So I'm kind of testing myself to see if it even makes sense to trade as actively as I do. But again, I'm trying to be true to my personality, and I think a good compromise is a hybrid approach between holding a core and trading around that core with a kind of a swing trading, sell strength, buy weakness type thing. So, I'll probably always do that, but I don't know that I'm always maximizing, my results. Paying taxes, short-term gains, and living in California, I mean, it's a pretty heavy burden to overcome. If you're paying over 50% in taxes, that's pretty tough to overcome that. So I don't know. Well,
Yeah.
I'll let you know the result in a couple of years.
Yeah, it makes sense. I trade mostly in my IRA, which is nice because there's no capital gain. So
Yeah.
yeah.
Well, so I actually, my largest trading account is my Roth IRA, which I converted years ago. And I have a position in this, by the way, that I actually bought on the upside reversal off the 21-day, right where your arrow is. So I actually bought it there. So yeah, my biggest account is my SEP, and yeah, that's the one that I can trade, as much as I want without having the burden of the taxes. But again, a large position in Tesla, and I just don't want to mess it up, because I think it can go a lot higher. And I've seen, it's funny, last year, every time I sold Tesla, it went higher every single time. And luckily, I was able to recover those shares on eventual pullbacks, but it always went much higher than I thought it would. You know, I thought when it would go on like a 40% run in 4 or 5 weeks, I thought, well, what more do you want? And I'd be scaling out. And next thing you know, the stock is up 80%. And I'm just the entire time, it's so much anxiety, wishing that I still had my position. So there is a big risk in losing your position in a stock and never really recovering it. Especially again, if it's a really high conviction name that you can see like a clear path for multiple years. So
Right.
I haven't decided how I'm going to trade Tesla. I think I will, the way I plan to trade it is on those obvious, or what appear to be obvious surges. You know, like if the stock went, you know, gapped up to 800 or something in the next week or two, I would take some off. But now that the stock has already had its major run, I don't anticipate anything like this kind of move that we had last year. I think it will now turn into more of a kind of Apple Amazon move that will take years to play out. And I don't anticipate many triple digit years in that stock, but I think there will be some, but thing like we had last year. And so I have to be a little bit more careful with it because it's just it's gonna be more of a patience trade, I think.
Makes sense. And is this your first position in this stock, or did you buy it through the kind of
First position?
first position?
I initiated a position. I didn't get it on the breakout.
Gotcha. Well, Charles, is there anything else you wanted to cover, or should we wrap up? I know we're way over already.
Oh my God, I can't be anyone listening at this point. I mean, you guys burnt everyone out. It's been an amazing conference, and just it was so packed with information. People must be exhausted. So I think I'll relieve everyone at this point, but you know, I look forward to the next time.
Perfect. And Charles, thank you so much for your presentation. The good thing is, even if they're tired now, they can come back, rewatch us anytime you want, rewind. And yeah, Charles, thank you so much for sharing your expertise. And I'll wrap up in just a second, but I'll be back in just a few minutes to wrap up the conference. But thank you guys all for tuning into to Charles' presentation. And yeah, thanks.
Thank you, Richard. Appreciate it.
Of course.